All right, so obviously all the focus right now on the U.S. consumer. This, of course, after an avalanche of disastrous soft data. You know the drill. This is University of Michigan, whether it's a collapse of sentiment or just really just outrageous expectations for inflation. Either way, it's been really a rough ride. On the other hand, hard data, of course, we know that has been much firmer. And give an example. Yesterday, GDP down 0.3 but final sales, right? Final sales, private domestic purchasers up 3%. And that's really your core real GDP number. And that's been steady. So that's hard data. That was pretty good. And then, of course, there's been a mixed picture with respect to these financial releases we're getting from companies. But I will say, some of these consumer-facing stocks have done okay. Look at Hasbro in the last week. This stock has been absolutely on fire, and it's not the only one. And it surprises me sometimes, the names that have done well and even offered guidance. But then there's the media narrative that says, well, we're all headed to hell in a handbasket, and it's all because of tariffs. Heck, they even got McDonald's. This is from FT today, and they essentially had a headline saying, well, this, because of tariffs, because of Trump. But this was also in the same article, which kind of blew me away because their own article shows when 2021 same-store sales peaked, have gone down consistently, and for the last 4 quarters have been negative. How the heck is this all about tariffs right now? Anyway, I think McDonald's probably got a little bit too cocky with those prices, right? Check this out. French fries used to be $1.79, now they're $4.19. I need some help with this. Let me bring in RenMac, head of economic research, Neil Dutta. Neil, to me, this is the story. And from 2019 to 2024, a cheeseburger went up 215%. What I'm curious about, was there a time where economists felt like maybe a burger, like eggs, are inelastic, like you can keep raising prices, but they were still cheap enough no one would blink?
Well, at some point, people are going to start responding to higher prices, and that might be happening. But I think the bigger story, Charles, is that labor markets are slowing down, and that's probably going to affect their consumer base more so than prices at this point.
What about, I don't know how you weigh this, but the reporting has been ultra negative, right? You look at Michigan sentiment,
sure.
Unsolicited responses. I heard something negative about the economy or the administration. There's never been anything like this. Can the negative stories in themselves have a self-fulfilling impact?
At some level, one of the ways bad things happen is through an element of surprise, right? Remember, going into the year, everyone thought things were going to be fine. And we had a very big downward revision to GDP growth expectations inside of 4 months. So it's that element of surprise that I think is more important.
One thing in your note from earlier in the week, and this is just one of the charts, you had a lot of great charts in there, with demand and employment. I don't know if I always thought, but I think people think maybe employment goes down and then demand goes down. But is it the other way around?
Well, I think labor demand is going down, and that's why employment is likely to go down. What that chart you have on your screen is showing you is basically looking at job openings versus the unemployment rate. And right now, you're seeing job openings decline. That was one of the data points that came out this week. And you're at a point now where if you continue to see labor demand cooling off, you'll likely see further increases in the unemployment rate from here. And I think that's going to ultimately pressure the Fed to step in.
I read a great piece from the Fed a few years ago, and it talked about this because everyone hangs on this Thursday unemployment number, initial jobless claims. Nothing's happening there. But on the back end of that, no one's being hired either. At some point, that starts to move the needle, too, for the U3?
100%, because it's about, you have to think about unemployment like water in a bathtub. You know how much water is going in, you know how quickly it's draining out. And the issue right now is that we're not draining out the water quickly enough because no one can find a job. So that means that the level of water in that tub, in this case unemployment, will keep on going up.
I want to ask about a couple other charts that you had in there, and with respect to, I guess, not necessarily self-fulfilling, but, consumers, right? Income expectations have collapsed. A lot more people see fewer jobs out there. What does this tell you about potentially being in a recession or being close to a recession?
Well, the economy was already slowing before anything happened on April 2nd. I think that's really important for people to understand. It wasn't like the Trump administration came in with a strong hand. Okay, they were dealt a pretty weak hand on their way in. And to me, it's really about distribution of risk. The fact that the soft data has been cracking like this just means that the distribution of risks have been shifting to the left. There's more potential for an accident to happen over the second quarter.
So I've got another chart I want to ask you about because the headlines, there's two things. We always get surveys. I know people, if you put a clipboard in front of people going into a supermarket, everyone's going to say things are bad. And they'll come out the store with like 10 bags of groceries or something. So expectations have been really in free fall for a long time,
Sure.
but the economy hasn't fallen off a cliff. So, how do you measure that? In other words, okay, we've got this data, everyone's screaming, everyone's nervous, but the economy is always resilient.
Well, I don't think tariffs represent like a sudden stop economic event, right? I mean, and that's what some of the soft data do show. This isn't like COVID. This isn't like the financial crisis. Tariffs don't represent sudden stop. But they do represent a negative supply shock.
Right.
And I think what you'll likely see is because expectations have cooled off, it probably means households start to raise their savings rate a little bit, kind of save for a rainy day. And that probably slows consumer spending in the process.
So where does this put the Fed?
Oh, they're cutting. They're cutting.
cutting?
I mean, I don't think it's happening in the next month, but I think the odds are quite high that they'll be cutting in at least by July. June's probably a 50-50 bet. But they're basically telling you that they're willing to be behind the curve. I think the most important chart that I had this week was wages and salaries, total wage and salary growth relative to the Fed funds rate. Wages and salaries are running below the Fed funds rate. Whenever that happens historically, good things typically don't happen. So I think the Fed's ultimately going to step in, and the risk, I think, is they'll end up having to do a little bit more than the markets are currently priced for.
With that in mind, then, let's say they did July and it was 50 basis points. Would that, Wall Street loves accommodation, Fed accommodation, but if it's that kind of a, number, would it also suggest, hey, we were late again and we might not be able to stop bad things from happening?
It would. I mean, if they're going 50 in July, that means the stock market's considerably lower than where it is right now.
All right, great stuff. Neil, thank you very
Charles.
much.
Good to see
Always
you.
appreciate you. Thank you.